So now we're dealing with our first rising interest rate environment in close to 20, almost 25 years. I mean, we're seeing, like, Keith and I on our side, we're seeing annuities and CDs and bond rates that we haven't seen since we started.
5.25%.
Yeah.
It's insane.
It's absolutely.
Yeah.
So obviously, that's on the savers end of things. But yeah, let's
great
talk
for
about
savers.
Right, exactly. Yeah, absolutely. Especially if you're conservative and you don't want to put any money at risk. And I love it because, and not to digress too much, but for, again, 20, 25 years, in our world, again, it was TINA, in the sense that there is no alternative when it came to stocks.
Sure.
So people would be like, okay, what rate of return do I have? Everyone would put money into equities because there was no alternative. But now, after 20 years, there is an alternative for the savers. But now let's talk about borrowers. Let's talk about people that are either buying a new home or refinancing or whatever that may be. I mean, at the end of the day, how do you
navigate this?
Yeah, exactly. How do you navigate that? Like, what do you tell your clients in a rising interest rate environment?
Sure. This is where I wish I had.
Is there like a strategy? Like, do I buy now, then expect to refinance in 2 years? You know what I mean? Like,
so this is where I wish I had a crystal ball,
Sure.
but this is where expertise.
I thought you brought it.
I know, right? No.
This is where kind of I don't want to use the word expertise, because we are in kind of unprecedented times for variable of reasons.
Yeah.
One, people got used to 2% and 3% interest rates. Well, that happened because we had a pandemic. I mean, unless we have what's truly a national disaster again, the likelihood of 2 and 3 interest rates is close to zero. I mean, we shouldn't have been there. That's not a healthy industry for us to be in. I mean, was it nice for people? Absolutely. But what does that do now? We have people in their 40s, 50s, 60s that are sitting on 2 and 3% interest rates that never want to leave these.
I was going to say they're going to be pretty hesitant. To,
so our new buyer now became
became
the ages of like 26 to 35 years old.
Right.
And these are people who didn't own a home or now just getting into the market. Yeah.
Maybe they don't show enough, income yet to even qualify.
And that's absolutely true.
Yeah.
I mean, the interest rates have definitely prohibited what people qualify for.
Sure.
There is a bright side to all of this, though. We've seen this before. Whether it's the Fed's raising interest rates, we know that inflation has to be combated by mortgage interest rates. Mm-hmm. The mortgage industry is probably the second driver of our economy in the United States. So what that means also is, while interest rates have to rise to combat inflation, we need to rebound the mortgage industry at some point too. So when we come down from this inflation, we need to beef up our mortgage side again, and we need to give people incentive to buy. And is that in
the form of like tax credits? Or, I mean,
I'm
sure
no.
Lobbyists
usually with interest rates.
Okay, I see.
So usually at the end run of
of a time like this,
a recession,
sure.
As a whole, interest rates get very appealing to spark the economy again and drive the economy.